Here in New Zealand, mortgage rates have pretty much tripled over the last 2 years or so. From about August 2021, we've seen rates go from 2-point-something% to where we are now in April 2023, where we're seeing rates at 6-point-something%, nearly 7%. Today I want to talk to you about practical things that you can do when you're coming off a low mortgage interest rate and having to refix on a higher interest rate. So first of all, I recommend that you start the process about 3 to 6 months out from your refix date and begin planning and calculating. Usually all the banks have some kind of mortgage calculator available on their website, or if you just jump on Google, you can type in mortgage repayment calculator and loads will pop up that you can use. Jump onto your bank's website and search up latest mortgage interest rates. This will give you the most up-to-date and recent interest rates that are available at your bank, and you can use these as a starting point for your calculations. Have a look at the rates available and choose one to work with. Usually the 1 or 2 year fixed rates are a good place to start. Go back to the calculator, key in your mortgage details, which you can find on your online banking, and also pop in the new rate. This will give you an estimate of what your new repayments may be when you refix on one of those higher rates. So now you've got an estimate of what your new repayments will be, and you can use these as a guide for step 2, which is act and live as if this is your mortgage rate today. Take some time to go through your budget and do a quick review to see if there are any expenses that you can reduce or cut back on so that you can free up some money to put towards your new mortgage repayments. Also, take a look at your income. Is there a way that you can increase your income? Maybe it's time that you ask for a pay rise, or maybe you could start a side hustle to bring in a little bit of extra money to put towards what your new repayments are going to be. Next up, start to live as if the new mortgage repayment amount is in place now. Again, I recommend starting this process 3 to 6 months out from your refix date. Pay your mortgage as it is, but instead use the new amount and set aside the difference into a separate bank account. This will get you into the mindset of living on a lesser amount and making higher mortgage repayments. I would recommend that you put this money that you're setting aside into a high interest savings account so that you can make the most over the 3 to 6 months that you're doing this exercise. Even better if you can put it into a bank account that you can't access or touch so that the temptation is gone and you're not going to spend it. Personally, what I do is I put this amount into a bank account with a totally separate bank to where my everyday banking is so that I don't see it and I don't have it in my mind every day when I do my banking. The amount's just tucked away for when I need it. So step 3 is at refix time, you can use this money that you've been setting aside into a separate bank account to make a lump sum repayment on your mortgage. This can help reduce the impact a little bit or even a lot, depending on how much you've set aside and what kind of lump sum repayment you're going to make on your mortgage. This can lower the blow slightly of moving onto a higher interest rate with higher mortgage repayments, as your overall mortgage balance will decrease. Again, what you can do is jump on and use those handy mortgage repayment calculators and pop in a lump sum repayment, play around with the numbers, decrease your balance to see how that lump sum repayment can have an impact on what your future repayments might be. The bigger the lump sum repayment that you can make at refix time, the more you can minimize the impact that's going to have on you with repayment increases moving on to a higher fixed rate. As you would have already been living as if your mortgage repayments were at a higher amount for 3 to 6 months, you should hopefully by this time be used to living on a lower amount and used to making those higher mortgage repayments. My other tip with this process is that you review every month over the 3 to 6 months that you're doing this to see if you need to make any adjustments to your budget and the amount of money that you're setting aside in case the repayments are changing over that time period. Say you review and the rates have gone up, maybe you need to increase your potential repayment amount and put a little bit more money aside. So to sum up, step 1, calculate what your new mortgage repayments are going to be on a higher interest rate and make a plan. Step 2, implement your plan and live as if you're already on a higher mortgage interest rate 3 to 6 months before your fixed rate rollover date. Review monthly over this time and adjust your estimated future mortgage repayments accordingly. This is especially important when in a rising interest rate environment. Step 3, make a lump sum repayment with that cash that you've been setting aside in that high interest savings account to lower your mortgage balance and reduce the impact that a higher interest rate is going to have on your mortgage repayments. Make sure that you make the lump sum repayment on your fixed rate rollover date and before your new interest rate takes effect. With a proper plan in place, you can take charge of your finances and set yourself up for financial success. A reminder that this is general advice only, and if you'd like to discuss your personal mortgage more, feel free to get in touch. If you like this video, don't forget to hit the thumbs up, subscribe, and turn on notifications so that you never miss a video. Thank you so much for watching, and I'll see you in the next one.